So a little different process here today. Our studio is currently under reconstruction, and my co-star, my left arm, if you Will Woodall, has earned a week off from video shoots. So, but the show must go on. So we're going to continue with the video shoot here. We brought in a special guest, Spencer Yurkowitz, who's one of our research analysts. He's been very much involved with our investment framework, does a tremendous amount of research and analytical work on our forecast models. So very happy to bring him in here today to help me go through the data. Spencer, welcome.
Thank you, Mike. Yeah, really excited to talk about some insights that we've got on markets and the economy this week.
Let's get right into it. We'll start off where we always do with prices, looking at returns as of September 23rd, so last weekend, and obviously a very difficult week for equities throughout U.S. and foreign equity markets, seeing negative returns, and in the U.S. equity space in particular, really seeing major equity indices come back down to their lows for the year. The last time we were down here was mid-June. So definitely a difficult week. It has moved the quarter-to-date figure negative and has brought a number of equity indices into bear market territory. It's down 20% or more from their recent highs. So with this price weakness, there are going to be folks out there talking about how stocks have gotten much cheaper. It's an attractive time to buy the dip, et cetera, et cetera. We want to talk about how we think about prices. Specifically, are they high or low, rising or falling? And for U.S. large caps in particular, our price regime is still actually high and falling. And so we wanted to provide some more context on that on the next chart. And Spencer, I'll hand it back over to you and talk about what we're seeing here and how we think about prices.
Yeah, so we look at prices through the lens of their long-term trend. So here we show the long-term trend return for U.S. large cap stocks. The average return for large cap stocks in that time period, approximately 8% annualized over that time period. And if we look at where prices are today relative to that long-term trend, you can see we're still above the long-term trend for U.S. large cap stocks. So all the way on the top right-hand side of the page, with markets selling off in the month of September, especially in these last 2 weeks, that's definitely driven the line closer towards trend, however, still elevated above that level currently. So that would indicate to us that prices are still at that high level, still above their overall long-term trend. So stocks still looking relatively expensive on this measure.
Yep. So yeah, high and falling of the 4 different price regimes for U.S. large cap stocks, that's actually the least attractive. Once large cap stocks get low, they become more attractive. So once they dip below that long-term trend, they start to become cheap. And then ultimately, we want to see low and rising. That's the most attractive price regime. And there is a point where U.S. large cap stocks have gotten so cheap that they've priced in all the negative news we've seen from our macro factors, inflation, liquidity, economic growth, and recession, but we're just not there yet. So with that, we'll move on to fixed income. And it was obviously a difficult week last week for fixed income. And we've seen this really all year. Bond prices and stock prices selling off simultaneously. Saw weakness throughout the U.S. Treasury market, as well as in high yield bonds, EM bonds, the plus sectors. And if we look at our yield regimes there, most higher quality areas of the fixed income market are in a high and rising regime, which is okay. It's nice that yields are high. You get a nice attractive starting yield, but we ultimately want to see those yields start to come down before we get into our most attractive regime. So the big news last week that drove interest rates higher, bond prices lower, was the Fed meeting. Spencer, can you just provide some insights on what we heard from Jerome Powell that ultimately led to the sell-off in the bond market?
Yeah, we ultimately didn't hear anything that was too far outside of what we've been hearing from the Fed since their Jackson Hole symposium a few months ago. So updated projections from the Fed, they raised the federal funds rate by 75 basis points. So that certainly had an impact on returns within fixed income, that being about right in line with consensus, but yields still rising after the fact. We also receive updated projections from the Fed in terms of economic growth in the labor market, reflecting some additional weakness there expected in the coming months.
Yeah, really just putting down on paper, everything that they've been alluding to for the last month and a half. And so now I guess now that it's down on paper, the market finally believed it and reacted accordingly. And as we get into the next area, the next asset classes, the alternative space, looking at global REITs and commodities, seeing negative returns there as well. Commodities in particular, as the Fed forecast a softening economic growth environment, slower economic growth, we saw commodities sell off due to increased recession fears. Now that we've gone through prices, we want to start going through the macro factors in our investment framework, the things that matter. So give an update first on inflation. And our inflation forecasts have been updated with the August CPI data, as well as projections for the Fed and our recession probabilities, but really not seeing a substantial change from what we looked at during the last video shoot. What you see is headline and core CPI still in a high and falling regime going forward. Good news, bad news. Good news is once we move from high and rising to high and falling, we move from a difficult environment for bonds to a very favorable environment for bonds. So we're looking forward to that, the falling aspect there. Bad news is inflation on a core and headline basis is still going to be high in our view for at least the next 12 months. And so with inflation being that high, that means that the Fed is going to continue to raise interest rates and most likely keep them high for longer, which has negative implications for the other factors in our investment framework that matter. But wanted to pause there and talk about a recent improvement we made to our inflation forecast models. We got some exciting new data. We think new data is exciting, so Spencer, can you talk about the recent improvement to our inflation models and what we worked on?
Yeah, we were able to add in one new input to our inflation models, which was unemployed persons to job openings, which is a relative measure of overall tightness in the labor market. It overall was a big quality improvement and especially important as we sit here today with a relatively tight labor market. So getting an understanding of how the labor market may impact inflation going forward.
Yeah. And didn't really revise our forecast. Didn't change our forecast trajectory too significantly, but really excited about that going forward, always trying to improve and refine our models. So with that, with inflation being high and the Fed continuing to hike and leave interest rates higher for longer, that has implications for liquidity or money supply growth. So Spencer, just talk about what we're seeing here.
Yeah, so overall, one of the important factors in our framework is liquidity as measured by the overall money supply in the economy. And what we're seeing right now is we're projecting still a slowdown in the money supply, one of the fastest slowdowns in history in the money supply following the stimulus that we received in 2020 and 2021. And so want to talk through the implications and what that will mean for asset classes going forward.
Yeah, low and falling liquidity environment is one of the most difficult environments historically for equities, particularly growth stocks. And as we keep tacking on additional months to our liquidity forecast, what we get is we're just going to be low and low. What we wanted to do now is dig in a little more into liquidity and talk about net liquidity. This is more sort of a real-time measure as to the amount of liquidity in the economy, the amount of liquidity that can really help propel asset prices higher potentially. So when we talk about net liquidity, we're talking about Fed assets. Fed assets are going down because the Fed is reducing the size of their balance sheet, minus reverse repo. Reverse repo is basically those are institutions in the economy that have excess cash say, hey, I don't need the liquidity, give me securities. So it's sort of useless liquidity. And then also minus the Treasury General account, which once again counts as money, but is useless liquidity. So if you take Fed assets minus these two things, you get net liquidity, which is sort of the amount of useful liquidity in the economy. And that's the green line. It has led the S&P 500 index pretty well. It's been a great sort of short-term leading indicator for the path of the S&P 500 in blue. So our net liquidity, we have a 2-week lead. What you see is it started to come down again, and then you also see that this downturn in equities that we've experienced since sort of mid to late August, all that's really done is brought the S&P 500 back in line with the liquidity environment that we're experiencing. So we expect this green line is going to continue to go down as the Fed continues to reduce the size of their balance sheet and they continue to hike interest rates. And as that green line continues to go down, it has been a force of gravity. And so this just goes to reinforce that relationship that we talk about. A low and falling liquidity environment is a difficult environment for stocks. When money isn't being created, it's difficult to continue to push equities higher. And that liquidity environment has implications for economic growth. We'll look at Q3 GDP Now forecast. Spencer, how has this evolved throughout the quarter?
Yeah, so here we're looking at the Atlanta Fed's projections for economic growth for the third quarter of this year. We're about a month away from receiving the actual number, but right now the projection is that economic growth for the third quarter will be approximately 0.3%. Now, what we've seen is that that's a pretty significant decrease from projections that we received at the start of the quarter, which is right around that target of 2%. Now, the two factors that drove the change since the start of the quarter has been a decrease in consumer spending. So following the sales data that we got last week, you can see like mid-September consumer spending flipping from about 2% down to about 1%. So that decrease impacting there. And then as well as residential investment, the poor housing data that we got at the beginning of September, beginning of the month, that drove down expectations as well for the third quarter.
Yep. And, we already had 2 negative quarters of economic growth in the first half of the year. Q3 looks like it's going to be a nail biter. I mean, at this point, it could be positive 1.6%. It could be negative 1% based on standard error of these forecasts. And so obviously, as we've said multiple times, we're on recession watch, which leads to providing an update in our composite recession forecast.
Yeah, so taking a look at our recession forecast here, probability of recession over the next 12 months sitting at about 54%. That is an increase from the end of the month last month. However, currently not projecting that we are in a recession right now. The big change that we saw to overall probability of recession has been primarily the market inputs. The market definitely negatively reacting to a lot of the data that we've gotten. The S&P 500 falling over the last couple of weeks, as well as high yield bond spreads expanding, and the VIX increasing, the overall measure of volatility in the market.
So yeah, with markets selling off and going back to where they were mid-June, we would expect that recession probability would probably start inching back towards the highs for the year. And so sort of putting all of this together, think about our macro outlook and our framework. Inflation looks like it's going to continue to be high. It will start falling, which is a good thing for bonds. Liquidity low, which is a negative regime or a bad regime for equities historically. And that combined with slowing economic growth and heightened recession probability, also pretty good for bonds and negative or a difficult environment for equities. So overall, our portfolio positioning and our outlook for different asset classes hasn't changed a whole lot. Continue to be very defensively positioned, overweighting high quality fixed income, being underweight equities, particularly growth equities. So all that being said, if anyone would like to discuss our outlook in more detail, our forecast models, or talk about your portfolio and how it's positioned, happy to do so. Please feel free to reach out. And thank you all so much for joining.